Titan, Asian Paints, Ujjivan, these are some of the high flyers for the day today, but the pain continues in PSU banks. Let's be very clear, the pain for PSU banks is just not over yet. So, where is the NPA picture likely to progress and move for PSU banks? To understand the impact of bond deal and much more, we are now joined by the CEO and Managing Director of Union Bank, Mr. Rajkiran Rai. Mr. Rai, good morning. Thank you for joining us. Now, losses have widened in Q4 and overall operating performance has been weak. What has led to this kind of a performance?
If you see the slippages this quarter, it is roughly 10,000 crores, and there was increased provisioning requirements because all these SDR and S4A accounts and a few of the restructured accounts which have to be classified as per the new regulatory guidelines, and some of these accounts straight away went to the D1 category which needed higher provisioning, and our bank has not taken benefit of the RBI relaxations also. So that way we are not having any backlog of provisions. So the loss may seem to be slightly higher than what is estimated, but then we are not carried forward any provisioning requirement to the next quarters.
You did mention that you don't have taken any benefit of RBI dispensation scheme and hence it will not impact your provisioning for H1. What can be the overall run rate in terms of slippages and recoveries in FY19?
See, I have not said that there will not be any impact in the next year because of these guidelines. This is a continuing guideline and there will be impacts. But for our bank, we have factored most of this impact in this quarter itself. But then there will be few accounts which may have problems in the Q1 and Q2. So we have already given our guidance that the delinquency for this year max can be around 3%, and the credit cost close to 2%, because there are some thermal power units which are in SMA 0, SMA 1 categories which come under the resolution plan as per the new guidelines. So they may create some problem in Q1, Q2. In our guidelines we have factored that.
So where is it that you see your gross NPAs and your provision cover by the end of FY19?
Now I will give you the closing figures for like expected closing numbers for the FY19. We have projected gross NPA at 12% and net NPA at 6%. This factors in the resolutions by NCLT of the first and second list, because this will get resolved during the next year, most probably most of them during the first 2 quarters, and other recoveries and upgradations are factored in. So we should end up with the 12% gross NPA and net NPA of around 6%.
What is your overall exposure to both the lists of NCLT? Because some sectors are still seeing that resolution. Hence, what would be the net impact of your provisions that you see post considering some of the write back in the few accounts?
See, our total exposure to both the list is around 12,200 crores, and our provision as of Q4 is 60%. So on the overall basis, we don't expect that we need to make higher provisions in any like in these NCLT accounts. But then when it comes to account wise, some of the accounts I may have 55% provision and maybe slightly higher haircuts may come. But on the large accounts, we are very comfortable with the provision we have. So I am not expecting any further hits by way of provision in these accounts of both the lists.
Right. You know, margins have been impacted by interest reversals. Is there a case for margin expansion? Where do you see margins ending in FY19?
Our NIM is projected to be 2.25 for next year. You have rightly put it, this year the impact of roughly 21,000 crores of slippages during the year and then the interest write backs, they have all like affected our NIM, even though our otherwise our average advances growth was around 12% throughout the year. So that is like if you look at our net interest income year on year, it is not decreased, but then the impacts were there. So we see a NIM of 2.25 for this year.
Right. Give us your sense on bond yields, you know, remaining elevated. Do you see high MTM hit in Q1 of FY19? Have you taken RBI dispensation to spread the MTM losses?
Yeah, I have clarified to you, we did not take any of these dispensation given on the provisions. We have factored everything in this quarter. So, when it comes to mark-to-market losses, actually, I think the worst is almost over, because in April, when we are given an opportunity to shift the accounts to STM category, we have done some rebalancing. So, we do not see at these levels any further mark-to-market losses, and maybe in this quarter we may see some losses due to the shifting of some of the securities to STM category, but we tried to cover up by trading profit, because we were sitting on some profits when we shifted these securities, but then suddenly the interest rates went up again, so we could not book those profits. So, we think that there will be some opportunity in this quarter. So, now onwards we do not see much mark-to-market losses, even if the yields are close to 7.70, 7.75 kind of range.
FY18 consolidation, so what is your credit and deposit growth outlook? Do you think you would be able to grow at a run rate which could be in double digit?
Yeah, on the deposit side, we have given a projection of growth between 8 to 10%, and credit we have projected 7 to 8%. This credit growth is on the net basis, because we are expecting at least 15,000 crores of resolutions plus recoveries on the large credit side next year. So, we need to factor that amount also, because the growth, we need to cover up that reduction due to recovery and resolutions. So, we are projecting about 7 to 8% of credit growth, and the growth will come from, like this year the retail we have done about 22% growth. MSME we were consolidating our book because of some pronounced NPAs. So, but this year we have built our structures, and some technology is also helping us. So, MSME we expect that about 5 to 6% growth will come this year. And the large credit selectively we will be doing. If you are we are rebalancing our portfolio in large credit also to a risk light model, capital light model actually. So, we have actually practically brought down risk weighted assets by 1.7%, over 7% growth in the assets this year. So, we will continue to rebalance that. So, the growth will come from all the sectors, and the large also, like there are good proposals. So, we will not be totally avoiding large credit, but then the growth may be, because there will be recoveries and resolutions happening. So, you will see a net growth of 2 to 3% in large credit this year.
Okay, pleasure speaking with you. Thanks so much for highlighting what the quarter gone by was like. About 2.5% lower for Union Bank as we speak right now in trade. What's happening with the rest of the market? Let's just throw focus on that as well. And largely we're standing status quo. So you are consolidating. We're holding on to that 10,750 mark for now. It's all about earnings reaction. Starting off with Nestle, which has seen a big uptick, 5.5% higher for Nestle as we speak. There's Asian Paints as well. It's been a very pretty picture in the fourth quarter numbers, about a 5% uptick